thanks everyone who's joined so far and is tuning into the recording as well. I think there's a few people already on, but yeah, usually over the first 5 minutes or so, more will join. So yeah, ready to go. Hey, hey, good to see Olivier, Shari, Steve. Hey, Dr. Will, how you going? Awesome. Hey, Yvonne. Awesome. All righty. Well, we might get cracking and get into our webinar for this week, which is all about our tax planning for 2022 and what that looks like. Before I dive in though, just a few events that are coming up with Inspire. The next workshop we're hosting on the topic of wealth for life is on Friday, the 22nd of April. And our awesome team, thank you, Tay, has just popped the registration link if you're interested in that. But that's from 9 a.m. to midday. And the East Coast of Australia is now all on the same time. So there's no two separate timings for that. So that's cool. But we'll be diving into the 9 steps to creating wealth for life, which is a workshop that we hold a few times a year. So if you haven't been to that one and that interests you, then feel free to book in for that one. Also next, or towards the end of this month, on the 28th of April, we've got Sakshi from our team presenting our Save Tax workshop. And again, the link is in the text box for that. Sorry, the chat box, apologies. And it should be running through some of our tax saving strategies in a bit more detail, and I'm going to run through today. That one's a 2-hour workshop, deep diving. I'm going to be covering a few different tax saving strategies in here, of course, because we're talking about tax planning for 2022. But it's at a high level. This one is the sorry, I just got a text from an attendee here. Yeah, the Save Tax workshop is at a much deeper level than I'm going to be covering today. Also, I can see quite a few clients in here, which is awesome. But there's also quite a few people I do not recognize the name of. And if you do want to have a call with one of our accountants about tax planning or about how we work with our clients, anything like that, then please feel welcome to book in for a strategy call with one of our accounting team. The link for that is in the chat box, and you can book a phone call, or we've just added the option of Zoom in the last month or so, which is a bit more personable way of saying g'day and answering all the questions. Cool. And lastly, if you don't know who I am, then my name's Ben Walker. I kicked off Inspire when I was 23. And we're now 9 years into business, which is pretty cool. So there's the maths on that in terms of my age. Yeah, I'm an award-winning chartered accountant with over 13 years of experience in accounting. And in 2018, I co-authored a book called Cashed Up, which outlines the 7 steps to pulling more money, time, and happiness from your business. And as a business, over the last 9 years, actually, we only started accounting in 2015. That was the first year we were sort of starting to track the impact we had on our clients, but we've saved over $18 million in tax and counting now. And I do believe by 30 June this year, that number will tick over $20 million. So I think we'll kick through about $2 million or more in tax savings in the next 3 months. And this is kind of the time of the year that we do this stuff. Proactively advising our clients, which is a great lead into the webinar itself, which is what we're going to cover is firstly, what is tax planning, and our 12 biggest tax planning strategies that we look at with clients. Also, a bit of a hairy one this year. The ATO has released some guidance. I don't know whether I call it guidance, but it's some frustrating news around trust distributions and how we use family or discretionary trusts. So I'll be going into a little bit of information on what you need to keep an eye out for this year. It isn't as simple, unfortunately, as it has been in the past. So that is something that I'll cover, and I've got a few examples as well. I'm fairly new to this stuff too, so I might not know every Q&A. Possible for it, but anyway, I'll give it a crack. And then lastly, we'll close out with some Q&A if we've got some time at the end. So cool, let's get cracking. The first topic is what is tax planning? And I don't think this is out of the Webster dictionary, but my opinion on it is it's a proactive process to implement legal tax strategies or tax saving strategies to reduce your tax bill. Now, key there is obviously legal. So we're not advocating for anything legal or something that even the ATO are kind of peering their eye into. We've got to work within the, I guess, this side of the line, so to speak, when we're working with clients, of course. And then the other key word there is proactive. So a lot of this stuff needs to be implemented before 30 June. We need to get the ducks in a row. We to expect to do tax planning on the 29th of June is a bit crazy. We do need to start early. And in fact, I think the team are actually starting to have their meetings at the moment. They've the first rounds with clients and questionnaires are being sent out as well to start this process with our accounting team so far. So we want to get started, in the month of April, really, so that our clients have, a few weeks or months to actually implement these steps. And then what does the process look like? So it's kind of at Inspire. So other accounting firms do this process as well. But here's kind of how I work with it at Inspire. So we deliver it between March and June every year. So we, as an accounting team, we've been preparing for this since even January, February, getting it ready. Towards the end of March, we start rolling it out for our clients. And then the goal is we need to estimate the profit for the year. Now, we work with business clients, and so we log into their Xero and see how their quarters have done for September, December, and March. And we need fairly accurate bookkeeping here. Otherwise, if it's not accurate, then our estimations are going to be out of whack. So we need to be careful with, how the bookkeeping's been done and making sure that's on time and accurate. And what we're finding is, clients need to have up to the end of March done. Now we're only 7 days into the new quarter, which some of our clients have bookkeepers that visit every week. They're the sort of clients booking in meetings at the moment because we can actually estimate what these 9 months look like. And then June is the one we estimate. And that involves having a conversation with our client saying, are you on track to keep is your income looking to be stable over the next few months, or is it going to go down or up? And we're able to edit, in our good old spreadsheets, what the revenue looks like, and same with expenses. Are you expecting any big bills? Annual insurance, for instance, is something that sometimes we don't know, but the business owner might. I got 20 grand in insurance premiums coming up in June. That's the sort of stuff we talk to. And then, any other considerations that the client wants us to think about for tax planning. We then go away from that initial phone call or interaction, Zoom meeting, crunch the numbers for the client, and then come up with some strategies to be able to save tax for that client. And that's where we catch up again to deliver our tax planning or tax plan, advise and decide on strategies. So we might come up with a dozen different things the client can do, and they might agree, hey, I want to do 6 out of 12 or 8 or all of them or none of them. And each strategy might have a cash flow requirement. For instance, you get a tax deduction for putting money into super. So we say, hey, if you put 10 grand into super, it might save you 2.5K in tax, and then you're tucking some money away into super for later as well. So, but clients might not want to do that, for instance. So anyway, that meeting is a collaborative effort of here's all the things we think you can do, which ones do you want to do, and finalize that tax plan. Out of that last meeting, we give a list of steps for implementation of that plan as well. So, pay that then, or pay yourself a salary bonus before the end of June, that sort of thing. So there is actually like a full-on plan that the client needs to follow to make that happen. So that is on a high level the process of tax planning. A lot of work goes into it, and at Inspire, it's compulsory for our business clients. It's part of the package that we do call It's All Sorted, because it is just so valuable having those conversations and making sure we do as much as we can to legally save tax. Now, how it might, like, again, this is very high level, but let's say the estimated profit for the year is $400,000 in the family group. Therefore, the tax bill is estimated to be $100,000. If we apply some various tax strategies, the tax payable might reduce to 75 grand, and therefore the value of tax planning for that client might be $25,000. And that's actually how we calculate the tax savings that we've done for our clients, so the $18 million over the last 7 years. Yeah, by adding all of these tax savings up. So yeah, that is the process. And I'm just keeping half an eye on the chat box and the Q&A. Nothing quite yet, apart from, yes, we will be doing a recording of this one and sending it out afterwards if you do have to go early or you missed the first bit. Cool. And then the other key one, I did mention this earlier, but please take action well before 30 June. You know, the 29th of June, you ring up your accountant, can I do tax planning? Geez, they're probably going to be flat out. You know, and if it's out of the blue for you or them, it's not going to be a great outcome. So again, we're starting this process now. It's a very busy time of year for us because we have this focus on tax planning. But yeah, I would recommend definitely getting started as soon as you can on this stuff. And again, with cash flow, some of these strategies we use do require cash to implement them. So please keep that in mind that you may need that to get it sorted. Alrighty, so we might kick on to the next section, which is the 12 biggest tax saving strategies, and just some context as well. Usually each year there's a couple of tweaks to these tax rates, but just a refresher on the 2022 financial year, which is the one that's finishing in 30 June. We've got the individual tax rates here, which, you know, the first 20 grand is the tax-free threshold. It's about 20K. There's a specific number, I just rounded it. But you actually pay no tax as an Australian adult resident. No tax on the first 20 Gs, and then 21% on the next bracket, 34% between 45K and 120, and 39% between 120 and 180. And then that top marginal rate is for individuals who earn over that 180 Gs mark in their own name. Now, those rates have got the Medicare levy attached to them. So the Medicare levy is 2%. So technically the tax rate here is, for instance, 32.5% plus a 2% Medicare levy. It does not include the Medicare levy surcharge. So if we've got clients in these higher income brackets, then private health insurance is the way you avoid the Medicare levy surcharge. And it usually becomes a no-brainer at a certain income level here. So, all right, so that's the individuals to keep in mind. Now, what we kind of aim for in terms of a magic number is this 120 grand in taxable income. That's where your tax rate goes from 34.5% to 39%. And there's usually maybe other places that cash could be distributed to. For instance, a bucket company is one of those examples, but we'll get on to a few different things there soon. Now, in terms of companies, businesses under 50 mil, we're looking at a 25% tax rate, which is the small business, or there's another word for it, but in English, it's the small business tax rate. Big business or over 50 mil, you're looking at a 30% tax rate. Or if the company only does investments, we're looking at 30% as well. And trusts, we don't want our trusts paying tax. Ideally, we look to distribute from trusts to other individuals or entities in the family group, and then they pay the tax for the trust. Okay. Now we've got our 12 tax saving strategies. First one here is salaries paid to business owners. Now, again, we're only going to cover these at a relatively high level, but these are the type of things we consider with a client. Many times we've seen business owners take the wrong amount of salary, whether it's too low and they're not drawing enough money out of their business to put food on the table, or they're getting into these things called Division 7A loans. If you know what they are, then you're probably dealing with them in some way. Yeah, we don't want to pay salaries too low or distributions too low. And on the other hand, we don't want to go too high necessarily to push ourselves in those higher tax brackets. Again, every client group's different. Sometimes we do want to go high for some reason. And sometimes we do want to go low, but at the end of the day, getting the salary right, or the distribution if you're in a trust, right from the business group, is one of those key considerations. And again, if there's a rule of thumb, that 120K mark is what we look for. If we're seeing, like, sometimes we do this thing called a look under the hood for people who want us to give a second opinion on their tax. One of the first things we look at is what's their taxable income personally. And if we see, like, $180,000, $200,000, $300,000 in personal income, and there's no decent reason why, there's usually some opportunity to better plan that one. Cool. Now, the next one, and these ones came under attack from the ATO in the last few months, but this one is work your family trust. I do have a little bit more info towards the end of the webinar on exactly what they're looking at here, the ATO. But at the end of the day, a family trust is a vehicle where if you earn taxable income in it, per trust law, you've got the ability to distribute that income to other family members within your group, or even entities like a bucket company or another trust, that sort of thing. So again, what we want to do here is make sure we decide on where it's going to go before 30 June. We've got to record that decision in a trust distribution minute each year. For instance, saying, oh, yep, 120 grand is going to spouse one, 120 grand to spouse two, and the balance to the bucket company, if that's what the minute needs to say. So we document all that, sign it off, and we use that when we prepare the tax returns as well. So yeah, we need to stay on top of these family trusts. So if you've got one, but again, if you're a client working with us, we do this process for you. We make sure we get those minutes sorted, and work out who gets what money. Now, the next one here, I've said this a couple of times already, but the amazing power of bucket companies. Basically, it's a mechanism we use when we've paid the people who run the business. Usually two spouses. We pay them enough money to live on, and then if there's any excess cash, any excess profit, we actually distribute that to a bucket company, because companies have a flat rate of tax, whereas individuals have a step, like it keeps going up the more they earn. Right up until 47%, which is a fantastically high amount of money, half your profit then ballpark going to the tax man. So if we distribute it to a bucket company, for instance, we're only taking a quarter of that instead of half of it, being taxed at, in a small business's sense, 25% tax. So it's a pretty good outcome compared to 47%. And even if a client's got $1 million worth of profit, we send it to a bucket company, we're still looking at that flat rate of tax. Now, there are rules around, it has to actually end up in the bucket company, or we might need to formalize a loan agreement back. Different things to consider there. We have a whole webinar on dealing with this situation in terms of bucket companies and how to spend the money. Actually, team, we might be able to track that link down, but that's the one about the Division 7A strategies. If we can maybe track down the link for the replay on that one, and we can pop that in the chat box. Not urgent, but if that's easy to find. Again, another thing to manage, but they can be fantastic vehicles to minimise our tax outcome. Alrighty, bring forward or prepay expenses. So this one's for small business owners where you can prepay up to 12 months worth of expenses before 30 June and be able to claim them as a tax deduction. So what we see here is, like, if a business has had a really good year, and for some business owners, that is definitely the case, even in this weird environment we're in. But we can look to prepay up to 12 months of expenses. So examples of that are insurance, or what we see is rent, especially when the landlord the business premises is actually maybe the client super fund. That's another way of getting two ticks there. Even subscriptions like software subscriptions, you can prepay in advance. And often a lot of them will offer you 10, 15, 20% discount for prepaying 12 months in advance. So it's a good way to get tax deductions, but also get a better outcome on the actual expenses of your business. We even offer it for accounting fees too, funnily enough, if you do want to prepay them. But we've seen other examples of business coaches or bonuses to staff, paying them this year instead of next. And that's a timing thing. At the end of the day, you're still going to claim the same amount overall. It just depends on which year it's in. But again, if you've got a massive year this year and you might not expect such a high profit year next year, it might be a way to balance out those tax bills. Just got a question from Tara. Hey, good to see you. For trading trusts, bucket companies still worth using given the increasing admin with Division 7A. So we do all the admin for you if you're using one of them. Restructuring the trust into a company. I guess, Tara, at the end of the day, if you're pulling out more profit than you're being taxed on personally, you'll still end up with a Division 7A loan anyway, whether it's in a bucket company or whether it's in a trading company. So yeah, it's more about how you manage the cash flow coming out of your business. But again, if you do end up in a position where you've got a Division 7A loan, there's quite a few different things that we can do to proactively get ahead of that. Division 7A loan agreements, paying the cash to the bucket company. We can even look to do a restructure of the family group, which can have a significant outcome on Division 7A loans as well. So, not sure exactly where the team are at with that link, but we do have some stuff. Also, yeah, as I said, like we've got this covered for you. And as you came on board this year, you'll be sorted. So it's all our admin rather than yours. Cool. All righty. Next one here. Don't pay tax on money you haven't received yet. So this is appropriate for, I say small business, but I'm going to say the smaller end of small business. There's no black and white or clear-cut rules for this tax saving strategy. It's in the grey area. There's a tax ruling somewhere on it. TR 98/1. I think there's actually a few accountants on here, but the idea here is that if you've got a service-based business where most of what you get paid for is not goods, it's service, and your turnover is, it's safer to be under $1 million, then we can look to have any amounts you're owed at 30 June. From an invoicing perspective or a debtor perspective, we can actually adjust that out of your tax bill, and you pay tax on your income on a cash basis, not when you raise the invoice, which, especially for, let's say you're a mining consultant, you might bill $300,000 or $400,000 in invoices a year, but they take 90 days to pay you. It might be $100,000 you're owed at 30 June that you haven't received. So the argument there is why should you pay tax on that? It's more appropriate to pay tax on your income on a cash basis, like when it's received, rather than when you sent them the invoice. Yeah, that's that one there. And with the expense side of things, we can treat that separately to how we treat your income, because it's a different set of tax legislation that applies to the expenses in your business. So we can claim your business expenses either when they're incurred or when you pay them. And in small businesses have that 12 months in advance that we can claim if you pay it up front. Cool. Number 6. Accelerated depreciation. Oh my goodness, hasn't these rules changed every 5 minutes in the last 2 years? But basically there are varying amounts of instant asset write-offs for, I think there's even, I think we're still in the unlimited period right now, where if you buy an asset For business purposes, we can claim the whole lot regardless of its price. And then it depends on also, if we look at assets you've bought over the past few years, when you bought them, how much we can claim. The other thing we look at, and this might be a separate strategy. It is a separate strategy. So I'll wait to strategy number 8. I was going to jump ahead then. But all about accelerated depreciation. So we, as a small business, we can claim a lot very quickly of all your assets and equipment. Again, that might be more appropriate for manufacturing or, businesses with warehouses or fleets of utes or trucks, that sort of thing. As an accounting firm, we've got lots of laptops and a bit of furniture, so it's not really a huge thing for us, but there are, those more substantial capital intensive businesses that this might apply for. Number 7, pay employees super early. So what we're looking at here is superannuation is due and payable 28 days after the quarter finishes. So the March quarter just finished on the 31st of March. So the super that accrued for January, February, March is actually due at the 28th of April. Hopefully that's not a surprise for many people. But if we look at the June quarter accrued super is payable on the 28th of July. Now, with super, we can tax deduct super when it's paid, not when it's accrued. So what we suggest here is if you've got the cash flow for it, just pay the super bill, a month earlier. We don't suggest paying it on the 30th of June because you want it to be taken out of your account in time for 30 June. So we suggest the latest you want to sort of wait for this is maybe the 20th of June, and that gives a few days for it to clear. So pay it a month earlier than you need to, and you get the tax deduction this year, not next year. So again, that's another example of a timing thing. So it's not going to save you tax necessarily if you look at the 2 years on a whole, but it might just help balance that cash flow from a tax bill perspective. And you can keep doing that one every single year as well. So, you do it this year, and then when next year rolls around, you do the same thing. Pay it just a month earlier in that June quarter. Alrighty. Now, number 8 is actually linked to number 6 I mentioned earlier, is write off your small business general pool. So this allows small businesses who are using that simplified depreciation method or the general pool to actually write off the closing balance of it. Now, if this has been treated correctly or the instant asset write-off has been done for you in the past, you probably won't have a general pool to write off. And I'm using a bit of accounting lingo at the moment, but it's the written down value of your assets per normal depreciation rules. And so we can, when it gets down to a certain level, we can actually write the whole balance off. And that balance depends on what year we're preparing and all of that sort of stuff. So that's something we do consider. And it does not apply to things like fit outs or construction that you do. That's under slightly separate depreciation rules. This is more like cars, furniture, equipment, that sort of thing, but not like walls and floors and carpets and stuff like that. Alrighty, so next one here is a motor vehicle logbook. This one's a no-brainer if you use vehicles heavily in your business. There's 2 ways now. There used to be 4, but now there's 2 ways to claim your motor vehicle expenses. The first one is the easiest, but it may not be the best outcome. It's the cents per kilometre method. Now that allows you to claim a cents per kilometre method on a reasonable estimate of what your kilometres are, only up to 5,000 kilometres in a year. Pretty sure I drive personally about 10 to 15,000 kilometres, maybe a bit more than that every year. So that one's probably not the best for me and other business owners. So the best thing to do is if you do use a vehicle for business purposes and private, we've got to keep a motor vehicle logbook, which shows the difference. Now, this logbook we need to keep for 12 weeks, basically 3 months in the financial year. And then we divide the business use kilometres over the total kilometres driven. And that gives us a % to apply to every expense related to that car. So whether it's the GST on the purchase, the depreciation, the fuel, rego, tyres, service, all that sort of stuff. So we can't just claim the whole lot if you do use it for personal use as well. And so, yeah, again, this one usually for business owners leads to a much better outcome than cents per kilometre. All righty, number 10. Be sure all family members are in the same tax bracket. Now, this is getting a little bit trickier, or it comes with conditions, which I'll share when I talk about the recent changes to trust distributions. But what we like to do is if we've got quite a large family and some of our family groups, a lot of the family members are all involved in the business anyway, we don't like to see huge variations in their taxable incomes because that usually is a bit inefficient for the tax outcome. For instance, we don't want one spouse paid 500 grand in income and the other one paid 50. We're going to have one person paying 47% tax on most of it, and then hardly any for the second spouse. So that's just a consideration we have. Now, if you've done tax planning with us, you would have seen this group tax summary we do. But what we want to do is just have a look at all the family members, where their current income's coming from, and then how we best distribute the remaining business profit or investment profit over that family group in the best way possible. Number 11, repairs and maintenance. So this is maybe just a bit of a check if there's any repairs and maintenance that needs to be done in the business anyway over the next few months after the financial year finishes. What we suggest is, hey, if there's stuff you can do now, get it done now. We can claim the tax. We can claim it on tax this year, and it might just be better, slightly better for your cash flow rather than waiting another 12 months to get the deduction next financial year. So again, just a timing one for that one, but still potentially a goodie. Number 12, and definitely not the end of the strategies we consider for our clients, but this one's write off bad debts. This one has to be done before 30 June. We can't just look back, where we're in September preparing last year's tax returns and say, "How these look like bad debts, are they?" We do have to. The rules say you've got to make the decision before 30 June. Of yes, we consider these as bad debts, and that what might be the scenario here is if you sent someone a bill 6 months ago, you followed up quite a few times, they haven't paid, and you feel like you've got little to no chance of recovering that, we can write those off as bad debts. If they end up due paying in the future, then obviously we've got to pay tax on that and realise the income. But as long as we've written off the debt before 30 June, as a bad one or non-recoverable, we can claim or adjust your taxable income for that amount there. Alrighty, so we're to the end of those 12 tax saving strategies, and then I've just got basically one slide on these differences in trust distributions. Now, there has been a lot of pushback from the accounting industry and industry bodies to just, I guess, keep the ATO in check here, not make sure they're going over a bit too far. But I've kind of put a slide here with the gist. There's a lot more rules, there's a lot more scenarios and examples the ATO give, but these are kind of the gist, and you'll sort of pick up what they're trying to have a go at. But in general, what they're looking to do is make sure that if you distribute profit to someone from a trust, the economic benefit ends up with the person you distributed it to. For instance, you and your spouse. So if you distribute to you and your spouse, that is generally very low risk. The ATO aren't going to worry too much, especially if it's paid into a joint account and spent on normal family stuff. The ATO gives some pretty silly examples of what might not be low risk here, like if the spouse it's paid to, the other spouse goes on a holiday without the spouse, and it's just really weird. It sounds weird even saying it, but yeah, if it's paid into the joint bank account for the family, spent on normal stuff, there's just no problem, or they say it's a low risk. Not no risk, low risk. And then if we have a look at adult children, now what that means is, if you've got two spouses or husband and wife with adult children, and we're looking to distribute to the adult children, the key with this is, let's say we distribute $50,000 to them. What they don't want to see is the child repaying or gifting it back to the parents. Makes a bit of sense where the economic benefit they want to see stays with the child. Now, you know, and then we can't advocate or do things like, you know, just have access to one of their credit cards and weird stuff like that. That's just, yeah, if the ATO catch onto that, they're not gonna have a great day. And same with, like, you know, if you try to come up with schemes to gift it back, again, not going to end well from a ATO perspective. And similarly with your parents. So sometimes we've got clients who distribute money to their parents or their in-laws. Again, repaying or gifting is clearly sort of high risk with what the ATO said. And the other one is same as retaining cash for working capital. That's for adult children or parents-in-law. So what that means is basically is if you distribute the money to them on paper but never pay the cash, but you're retaining that cash in the business or in the trust to invest, or working capital, whatever it is, if you're not paying it to them, and we've got a bit of a problem with these rules that are brought in. So they're very new. I think they might have been released about a month ago. If you're a client, we'll tell you about this in your tax planning meeting and work to see how that might impact your distributions. If in the past they might come under this sort of medium or high risk stuff. But again, like they've, and even for quite a few years, we've been saying to our clients that if you distribute on paper to other than you and your spouse, then you need to be paying that cash. And yeah, what this does is take that a step further and say they can't gift it back, they can't loan it back. They've got to spend it on their own stuff. All right, Liz has asked, can the bucket company be the trustee of the trust and distribute to the trustee company? Well, what I'm guessing you're saying there, Liz, is can you have like a trust that runs a business that's got a corporate trustee and use that as the bucket company? I'm probably going to say we wouldn't do that because of asset protection, and it just gets a bit weird where the trust is distributing to its own trustee. So yeah, I definitely wouldn't do something like that for kind of two reasons. Yeah, but if you could or not, I don't know, actually. Someone else, Anonymous. Anonymous has asked, how far can you extend your family trust? For example, can a sister or nephew be included in the family trust? Now, sometimes like sisters are, sorry, when you set up a trust, you usually nominate primary beneficiaries, and they're people who the trust is basically set up for and to primarily benefit. But then in the rules of the trust, there's secondary and tertiary beneficiaries, which can include mums, dads, in-laws, brothers, sisters, children, grandchildren, nephew, niece. Like it depends on what the trust says. It depends on who you can actually distribute to. So it would depend on the terms of your trust for that one. Rachel has asked, what about adult children who are living at home rent-free? I was advised that distribution could be on paper as adult child is being supported financially through family. Now, that's a very common understanding, Rachel, what you brought up there. This is kind of in that, I've got examples off the presentation, off the slide. Let me just see if I can find a similar one. It might be a minute or two. Okay, here we go. So this is not exactly your example, but close. So the trust distributes some income to the adult child. The adult child agrees to pay the after-tax distribution back to their parents to repay them for the cost of school fees and extracurricular costs paid by mum and dad in prior years. So what that's saying is we can't kind of, and sorry, what they say on this is that is very high risk. They don't want to see that. And what they're saying is like, I've got young children right now. If I start accruing a loan account for everything I pay them for, that might be, 500 grand by the time they're 18. So they don't want to see that thing being built up. And then you pay it back when they're 18, 19 onwards. But that's not quite your example. Let me see if I can find that one. So another high risk one is if the adult child receives distribution and agrees to put it on mum and dad's offset account, that's a no-no. Here we go. Trustee distributes to the adult child. The adult child lives with them and has agreed to pay them arm's length board. So what normal board would be. The trustee, the trust pays the parents or whoever the person that board is owing to. That is low. But the key there is arm's length. So, and this is where in principle, Rachel, like, if you've got an adult children living at home, could you pay them? Would they cost you 20 grand in stuff, expenses and that sort of thing a year? I'd pretty reasonably argue that yes, but now we have to be a little bit more scrutiny focused on this stuff and say, well, if they were paying board for what they get, what would that be? Looking at what someone else would pay to live at home, like it just takes it a little bit to the next level, unfortunately. But your example there can work. It just can't work for prior years or loans built up since they were born. I wish it could. Alrighty. Cool. All right. Well, that's kind of, I've got more examples here that, and they're finicky and frustrating, but it's what we've got to live with at the moment. And as I said, there's a lot of pushback from the accounting industry to say, hey, don't be silly. And some of these are so ridiculously complex to work out whether they're able to be done. But if we're working with you through tax planning and you've got specific questions, we'll work as best we can to give you some guidance on it. But it's the way of the road at the moment. Tani has asked, what's the amount payable to a child under 18? Is it about $400? I think it's $416 at the moment. Maybe it's a couple of dollars either side of that, but 416 is the number in my mind for quite a while now, Tani. So we can't do a child under 18 any more than that without going straight to the top marginal rate in tax. Yvonne's got a logbook question. I think you sent your initial thingo through. I might do Q&A. I'll keep doing Q&A at the end, but still send your questions through. I just want to cover off some other things. We do have all our recordings of all our webinars and other content that we publish on our Facebook. That's a huge platform that we use. So if you do want to give us a like or a subscribe, we've got all our things there, and that's where we share a lot of the content that we produce as well. And another reminder as well, if you do want to have a talk to one of our accounting team about what our tax planning process looks like, then please book in for a strategy call. The link to do that is in the chat box right now. You can chat about what tax planning looks like. If you've got some random tax question you want to ask, or you want to explore changing accountants and what it looks like working with us, then feel free to do that. And then we will have a bit more Q&A. And Yvonne has asked a good question, which I didn't answer earlier. Do you have to record your logbook every year for 12 weeks? So 12 weeks every single financial year? The answer is no, thank goodness. If there's been no material change in how you use that vehicle, that logbook is good for 5 years. But, things that would change that is if, like COVID, for instance, when it hit, a lot of people use their cars less, or if you're working from home office is different to what it used to be versus the office in the city and wherever it is. And therefore your business use of your car changes. if you were to move offices or houses, or you started going to clients more, like all of those sort of things might trigger a material change in the way you use your vehicle. But if it's minor changes, then that logbook will be good for up to 5 years before you have to do it again. Alrighty, well, we might finish up the webinar there. Thanks for everyone who joined. I hope that was helpful. And if you are a client, if you haven't received your first steps on getting your tax planning started, that will probably be over the next week or two before we can start getting those sorted. And yeah, I appreciate the support, and thanks. And I will see you on the next webinar or workshop. Thank you. Thanks, everyone.